The question sounds simple, almost seductive. Mutual funds or hedge funds? Which one makes you richer? Here's what nobody tells you. Richer is not a number. It's an outcome shaped by structure, access, patience, and survival. These two vehicles were not built to compete on the same field. They were built to solve different problems for different people at different moments in financial history. If this pattern applies, then comparing them head-to-head without context guarantees confusion. At first, it looks like sophistication wins. Then the bill arrives. In 1924, the first mutual fund promised diversification to ordinary investors after repeated market shocks. In 1949, the first modern hedge fund promised protection against volatility through flexibility. In the decades that followed, fortunes were made and quietly lost inside both. The unresolved question isn't which one can generate the highest return in a good year. It's which one still works when markets turn against you. This is where the pattern begins. Mutual funds were born from failure. After repeated market panics in the early 20th century, concentration proved deadly. Investors needed spread, not brilliance. The mutual fund offered pooled capital, professional management, and diversification in a single package, not exclusivity. Scale, not secrecy. Transparency. By the mid-20th century, mutual funds became the backbone of retirement systems and middle-class investing. Their promise was stability through averages. You wouldn't beat the market spectacularly, but you wouldn't be destroyed by a single bad decision either. Hedge funds emerged from a different anxiety. In 1949, Alfred Winslow Jones created a structure that could go long and short, use leverage, and adapt dynamically. The goal wasn't to match the market. It was to sidestep it when needed. At first, it looked like a miracle. Then the bill arrived decades later in the form of complexity, opacity, and uneven outcomes. Hedge funds promised absolute returns, but delivered dispersion. A few extraordinary winners, many quiet underperformers. Survivorship bias did the rest. Here's why this matters. Mutual funds are designed to survive. Hedge funds are designed to exploit. One prioritizes endurance. The other prioritizes opportunity. Not safety. Flexibility. But flexibility cuts both ways. When it works, it dazzles. When it doesn't, losses compound invisibly behind lockups and limited disclosures. By the 1970s and 1980s, the divergence was clear. Mutual funds scaled massively as pension systems and retirement accounts expanded. Hedge funds remained small, elite, and lightly regulated. Fees told the story. Mutual funds charged modest management fees, often under 1%. Hedge funds adopted the now famous 2 and 20, 2% management, 20% of profits. The promise was skill. The cost was permanent. Here's the mechanism. Fees compound regardless of performance. In mutual funds, they slowly erode returns over time. In hedge funds, they skim upside aggressively while losses remain yours, not shared pain. Asymmetric reward. Over decades, this difference becomes decisive. The danger wasn't what people saw. It was what they ignored. During long bull markets, hedge funds often lagged simple index strategies after fees. Yet capital continued flowing in. Why? Psychology. Exclusivity feels like intelligence. Complexity feels like control. Mutual funds felt boring. Hedge funds felt elite. At first, hedge funds appeared resilient. During certain crises, some protected capital while markets fell. Headlines followed. Capital chased performance. Then repetition set in. According to long-term studies, a large percentage of hedge funds failed, closed, or merged within 10 years. Survivors defined the narrative. Casualties vanished from the data. This is where comparisons became distorted. Mutual funds, by contrast, rarely disappear dramatically. They merge. They underperform quietly. They persist. Their failure mode is dull. But dull survives. Here's what nobody tells you. Survival is the most underrated form of return. In practice, most mutual fund investors experience the market's long arc. Growth interrupted by drawdowns, smoothed by time. Most hedge fund investors experience manager risk. Outcomes depend not just on markets, but on judgment, discipline, and timing. The danger wasn't volatility alone. It was dependence. This difference reveals itself under stress. In crises, mutual funds fall with markets, but remain liquid. Hedge funds may gate withdrawals, impose lockups, or suspend redemptions. Not fraud. Structure. Protection for the fund, not the investor. Everyone thought liquidity was guaranteed. It wasn't. Here's the trap. Investors compare headline returns without accounting for access, timing, and behavior. Hedge funds that post spectacular gains often do so with concentrated bets and leverage. Losses arrive just as spectacularly. Mutual funds rarely soar, but they rarely implode. Not excitement. Endurance. Over decades, this structural divergence defines who gets richer and who stays rich. Mutual funds reward patience and consistency. Hedge funds reward selection skill and punish mistakes mercilessly. According to some analysts, the median hedge fund has historically struggled to outperform simple diversified portfolios after fees over long horizons. Not because managers lack intelligence, because the hurdle is brutal. The emotional component seals the outcome. Mutual fund investors are more likely to stay invested through downturns because movement is slower, pricing less intrusive. Hedge fund investors monitor performance intensely, amplifying reaction risk. Let me show you exactly how this plays out. When volatility rises, hedge fund strategies shift, leverage changes, exposures rotate. Investors interpret this as action. Sometimes it's protection. Sometimes it's desperation. Here's what nobody tells you. The richest outcomes often come from minimizing mistakes, not maximizing brilliance. Mutual funds institutionalize that principle. Hedge funds challenge it. By now, the original question has begun to fracture. Which makes you richer? Depends on time frame, temperament, access, and survival. It depends on whether you measure peak value or final value. It depends on whether you can endure drawdowns without intervention. And this is where the real comparison begins, not in returns, but in behavior under pressure. Because markets don't test intelligence first, they test discipline. What happens next depends on how these systems behave across cycles, and how investors react when the environment turns hostile. That's where wealth is either compounded or quietly transferred away. The second act begins when the market stops cooperating, and structure reveals its true cost. Here's the mechanism. Wealth doesn't compound in ideal conditions. It compounds through stress, boredom, drawdowns, and time. Mutual funds and hedge funds respond to those conditions very differently, and those differences decide who ends up richer when the cycle closes. Mutual funds are built for continuity. They assume markets rise over long horizons, fall periodically, and recover eventually. Their structure forces participation in that cycle whether the investor feels confident or terrified. Prices move once a day. Redemptions are processed with delay. That friction is not a flaw. It is a behavioral shield. According to some analysts, this friction prevents catastrophic timing errors by making impulsive exits harder. At first, it feels restrictive. Then the bill arrives, in the form of resilience. Hedge funds are built for discretion. They assume markets can be navigated, sidestepped, or exploited through skill and flexibility. They trade frequently, shift exposures rapidly, and deploy leverage when conviction is high. In the right hands, this can generate extraordinary outcomes. In the wrong moment, it can destroy capital faster than markets alone ever could. Not participation. Judgment. And judgment is fragile under pressure. Here's why this matters. Most investors don't fail because markets fall. They fail because they react to falling markets. Mutual funds limit reaction by design. Hedge funds amplify it by necessity. Managers must act. Investors must assess. Every move becomes a signal. The danger wasn't what people saw. It was what they felt. Fees accelerate this divergence. Mutual fund fees grind returns slowly, but predictably. Hedge fund fees extract upside aggressively. A hedge fund that earns 20% may deliver far less to the investor after fees. If it loses money the following year, the loss belongs entirely to the investor. Performance fees reset incentives asymmetrically, not shared downside, optional upside. According to some long-term studies, hedge fund indices have struggled to outperform simple diversified portfolios over extended periods once fees and failures are fully accounted for. This doesn't mean hedge funds don't work. It means most don't work consistently enough to overcome their structure. Survivors dominate headlines. The graveyard remains silent. This is where survivorship bias becomes lethal. Investors chase the funds that survived the last cycle, unaware that survival itself filtered the data. By the time capital arrives, conditions have changed. Strategies crowd. Returns compress. Risk rises invisibly. At first, it looks like safety in numbers. Then the bill arrives in correlation. Mutual funds suffer from a different flaw. They guarantee mediocrity by design. You won't escape market drawdowns. You won't sidestep crashes. But you also won't bet the farm on a single thesis. According to historical data, Time in the market has mattered far more than timing the market for diversified investors, not brilliance. Persistence. Here's the trap. Investors confuse complexity with protection. Hedge funds feel safer because they are doing something. Mutual funds feel passive, even vulnerable. But activity does not equal safety. Often, it increases risk. In stress, complex systems fail in unexpected ways. Simple systems fail plainly and recover. Liquidity exposes the final difference. Mutual fund investors can exit daily, but usually don't en masse. Hedge fund investors may be unable to exit precisely when they want to. Gates, lockups, and suspensions appear not as betrayals, but as structural safeguards for the fund. Not access denied. Timing denied. According to some analysts, the worst outcomes occur when hedge fund investors need liquidity most. Forced illiquidity turns paper losses into psychological trauma. Decisions are made under uncertainty with no control. This is where wealth transfers silently, from impatient investors to surviving managers and remaining partners. So who actually gets richer? In one scenario, a disciplined hedge fund investor with access to elite managers, patience through drawdowns, and tolerance for opacity may outperform dramatically. In another, the same investor underperforms badly due to timing, fees, or strategy drift. In a third, the investor never sees the full outcome because the fund closes or restructures. Mutual fund investors experience fewer extremes. They rarely outperform spectacularly. They rarely implode. Over decades, compounding does the work. According to conditional historical patterns, boring consistency has built more durable wealth than episodic brilliance for most participants. Here's what nobody tells you. Hedge funds can make you rich quickly. Mutual funds can make you rich slowly. But only one reliably keeps you invested long enough for compounding to finish its job. The final truth is uncomfortable. Wealth is not built by choosing the smartest product. It's built by choosing the structure you won't abandon when fear arrives. Mutual funds assume you are human. Hedge funds assume you are exceptional. Very few are. So the real question was never which makes you richer. It was which one you can survive long enough to let it work. And in markets, survival is the rarest edge of all.